Hello, everyone, and welcome to another edition of the Money Pros. I'm Oliver Tutt, certified financial planner practitioner, and I'll be your host for the next half hour. So we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Let me give you an idea of what we're going to talk about on today's show. I'm calling this show Survey Sunday because I'm going to do two segments on financial surveys that came out. I always think they're interesting to talk about because it gives you an idea of where people's state of mind are or is on a variety of different financial issues. And there were a couple that caught my attention over the past week, so we want to talk about those. The first one is a question of whether or not money can ruin a friendship. I think we probably all agree that in certain circumstances we could all fall victim to that. But we're going to talk about how easy that actually is. Getting away from the surveys for a moment, we're going to be talking to our tax pro, Greg Piccaro, CPA and partner with Otrando Piccaro & Associates. A lot to talk about. It's year-end tax planning time, so we want to go over some tips on that. We're also going to touch on the proposals for tax reform that are in front of our legislators as we speak, and try to stick our finger in the wind and see where things are going to give you a little bit of a heads up on what you might be thinking about for next year. Then we're going to return to surveys by talking about whether or not it's likely that people would return to full-time work or any type of employment for that matter after they retire. And you should ask yourself how likely you'd be to do that. And then we'll take a look at what the reality shows us. And then finally, a little stock market trivia. We're going to be talking about a 130-year trend in the stock market that came to an end this month. This show is being taped on November 1st, and so the trend came to an end just yesterday on Halloween, 130-year trend. So I'll tell you what that is at the end of the show. So let's leap right into things. And the first thing we want to address is the question of whether or not money can actually ruin friendships. I think this is why a lot of lottery winners, perhaps not enough lottery winners, claim their prizes in private because they don't want all of their friends to know how much money they have, recognizing that indeed large sums of money could certainly ruin a friendship. But I think it's also interesting to address the question of whether smaller sums of money could mess up a friendship as well. So what brings this to mind is you've probably all seen the commercials done by Bank of America where they have a couple of friends sitting on a couch and they're talking about some special event that they went to or something they did, and then it gets revealed that one of the friends borrowed money for the event from the other friend and they were never paid back. And there's a couple of these different commercials, but this is all to advertise for a program Bank of America offers to make it easier with an app on your phone to transfer money between friends under the premise that it's easier to pay them back. But in conjunction with this marketing campaign, they did a survey testing how important it is to pay your friends back and whether indeed small amounts of money could affect a friendship. So they surveyed 1,000 people nationally, and let's throw up a slide, talk about some of the interesting findings as part of that survey. So they indicate that this is actually the fourth largest cause of problems in a friendship. There are other things listed were things like gossip and things along those lines. But money was the fourth largest cause of problems in friendships. Additionally, 77% believe lending money can be harmful to a relationship. I'm a little bit surprised that that number isn't higher. Certainly you are playing with fire if you're lending money to friends, and all situations vary, but 77% of people believe that that would be harmful to a friendship. 75% would end a friendship over a disagreement of $500. So it doesn't take millions of dollars or becoming a lottery winner to alienate your friends. You could have an issue, according to 75% of the people in this survey, with somebody for as little as $500, and it could potentially ruin a friendship. And then finally on this survey, 40% have avoided friends who owe them money. Now, this is a little counterintuitive. I would think that if somebody owed you money, you'd be looking for them. That is the state of mind of a lot of people that I know. But 40% of people indicated that they would avoid friends that actually owed them money, suggesting that it certainly presents a lot of difficulties. So what can you take out of the survey? Well, everybody's opinion on this is different. But the reality is that how you look at it may be different than how your friends look at it. So I think you have to be very aware that when you start to blend money and friendships, I mean, the old saying is don't talk to your friends about politics, religion, and money. And certainly when you start to mix money into the conversation or into the relationship, you start to play with a little bit of fire. So you have to think carefully about how you feel about it and also potentially how your friend feels about it. And a final disclaimer on this topic, this is in no way an endorsement for Bank of America's new mobile app on transferring money. I'm sure there are a lot of ways to pay your friend back. I'm sure cold, hard cash would work just as well as an electronic transfer. So with that, we'll take a pause for a commercial, and when we come back, we're going to talk to our tax pro, Greg Piccaro, CPA and partner with Atranda Piccaro & Associates, about year-end tax planning and potentially what to expect for some tax reform next year. Stay with us, there's more to come. Hey everybody, welcome back to the Money Pros. One of our favorite guests, of course, Greg Piccaro, CPA and partner with Atranda Piccaro & Associates. It's that time of year. This is like the only break you get, and I hesitate to call it a break because you're always busy.
It's a transition.
It's a hopefully a peaceful transition. But we've done this before. I mean, you've been on the show for 7 years now, so and
wow.
I don't think that there's a year that's gone by where we haven't talked about year-end tax planning. I think a lot of people feel like, well, you know, my taxes are due April 15th, so the tax planning should take place prior to that. But the taxes are all about the calendar year for the vast majority of people, so the planning's got to take place in the calendar year. So we're really coming up on the deadline. Here it is, the beginning of November, for if people are going to make changes, it's got to happen now. It can't happen, you know, April 10th or something like that.
Or January 1 is really the key, right? After that, we got a whole new game, clock to start. So
you got by October 15th.
Right.
The extensions are done and in the mail, so to speak. So now what?
So that's the time. So from our perspective, and you're right, we've done this show a lot of times, it's important because, as they say, you know, death and taxes. We're going to have to deal with this issue every year. We can't avoid it. And so typically we wait till the fourth quarter because you can't start really planning in June unless there's a major transaction. So if you sold a piece of real estate, have a huge gain, and you did that in June, we could plan from June to December. But for people who are basically operating their business, for example, and that's usually the people who are self-employed that have the more variability, though there are situations where an employee might get a raise or a bonus or switch jobs, and all of a sudden they have these changes they have to adapt to. But the fourth quarter is the best time, in my view, to start that process. From October 15th to now, we kind of evaluate all our clients who had problems, owed money they didn't expect, who got refunds that were too big, who had a transaction in the course of the year that we know of that's going to impact their income tax situation. And keep in mind, when we talked about this last year, we were anticipating tax reform to already happen. So we did a lot of planning at the end of last year, anticipating reductions in tax rates in 2016 that so far haven't materialized. So a lot of people trying to defer income wherever possible into a year they hoped the rate would be lower. But that so far hasn't happened. We'll talk about that a little bit later.
So we're definitely going to talk about that, and we may talk about that several times. But as the end of the year looms, what should people be looking at when it comes to the planning that they
Well, I
should be
think
doing?
for someone whose situation is relatively straightforward, they're in the same position, same basic family structure, same mortgage, et cetera, then there's really probably not much. If you got a refund and it wasn't too big, then I'm saying you're probably in pretty good shape. The one thing you should always do is reevaluate your contribution to your retirement accounts, whether it's a Roth type or not. I tell people, if you get a raise, put as much of that raise as you can afford into your retirement account if you're not already maxing out. So it's definitely not too late for that. Even for someone who has the situation well organized or easy to anticipate, put as much money away for retirement as you can. I mean, there's no, from what you do, that's really critically important. So, but for people whose situations can vary, so when they finally got around to finalizing their return, whether it was in April, and a lot of them aren't, or in October, if it turned out that they were not on track, they owed money, we got to make changes to that. Many times they don't know until October because there's those people that procrastinate. And so we need to, between now and then, make an estimated payment, increase withholdings, contribute to their 401k, find a way to manage the liability so they're not surprised. I've had too many of those conversations where people all of a sudden owe more money than they expected. and they don't necessarily have it readily available.
Just like when they found out in April or October of this year that they had a problem for last year, and it was too late to do anything about
That's
it.
right.
It's going to be too late to do anything about it next April for this year.
That's right.
The moves have to be made now.
So for the people that are not procrastinators, we pretty much have a handle on what happened between, so from like May to July, we'll set up estimates, make sure they're on track. But the other typical things change. Marriage is a typical one. People get married, now we got to combine incomes. I've met with a lot of newlyweds who kind of wish they didn't get married after that because the tax situation's totally different.
Sure.
And there are some of them. One of them might be accustomed to getting a refund all the time, but the other's not. And now all of a sudden that refund's evaporated. We have to try to balance that off to maintain harmony in the household.
Right.
So I encourage people when they get married, do that early so that you're not surprised one way or the other. And sometimes people take the default trip and they go, well, I'm just going to file separately. Well, that's all well and good, but in many, many cases,
rarely the good solution.
it costs a lot more money depending on income to file separate returns. And it could be a lot more money. So if your income's relatively low, like $40,000 or so a piece, filing a separate return's probably not going to make a big difference because up to the 25% bracket, they're pretty level. But once you get into a higher income, we did this for a client, newlywed person, and I think the tax saved by filing a joint return because his spouse didn't have much income in relation to his was like 12, 15 grand. So that's like a lot. That's like a crazy amount of money if you just filed one form instead of two. I mean, and he wasn't even thinking about it. So I said, look, we got to at least look.
So phase one is going to be looking at changes, and you mentioned getting married, but what are some of the other changes quickly that should trigger in somebody's head? This might affect my tax return. I got to look at this.
So I meet with someone next week, for example, who started a business in the beginning of 2017. And he told me this was going to happen. I said, well, we need to meet before the end of the year to see what kind of, are we making money, are we not making money? Now they're self-employed.
That can make a startling difference.
Startling
on your
difference, right?
tax
You're not paying in because now you're self-employed, so there's no withholding, and the self-employment tax on top of your income tax could be a significant tax liability. So that's if you started a business or transition from employment to self-employment, you probably should have planned a little bit earlier,
Right.
but it's definitely not too late. Because you want to know, and sometimes there's nothing you can do. Many times there is. I can't tell you how many times with a plan in mind they can move forward and not eliminate but reduce. But if they don't know, and then the balance and the liability pops up in April, and they could owe tens of thousands of dollars they didn't know they were going to owe, and many times they didn't save the money. Sometimes people put the money aside, which is great. So I've had these conversations, and that's all right, I got the money, I knew this was going to happen. That is not the typical scenario,
Sure.
unfortunately.
Marital status, starting a business, or changing employment status in some way like that. Anything else?
Children.
Okay.
If you have children, that does have an impact. Kids going to college, now you got that education credit still in the pipeline. That could be helpful for families whose income qualify, and that's $2,500, so it can make a difference.
Okay, so you did what you were supposed to do. You looked at the changes. Ideally, you're talking to a tax professional about this to help walk you through it, because this stuff gets awfully complicated. And you make a determination that your liability isn't going to match up with what you've put away in some way. So what do you do? I mean, what's the next step
Well,
here?
fortunately, the government has and we had a show about paying the government the federal government when you owe money, and they've actually made it better. They've streamlined the process, so you can actually go onto irs.gov, and if your liability, I believe, is under $50,000, you can apply for an installment agreement online independently. You just put in the information and you can get a payment plan pretty much approved in whatever range that you need, as long as it's paid over a certain period of time. So you can't get an installment agreement. Now, the federal interest rate's much less than state interest rates. So as you know, Rhode Island's interest rate's 18%. So when people have a problem like this, I say, look, make sure you pay the state, because the federal rate might be 5+%. It's nowhere near 18. So even considering penalties, which are almost the same on both sides, interest rates are killer at the state level, and I think even Mass's is pretty high, like 12 or 14%.
Wow, okay.
So it's a lot. So you want to factor that in, pay the state if you can, and then work with the feds, who have a much better, more streamlined process for requesting a payment plan anyway.
What about the flip side? What if things look good? You started that business and it ran a huge loss, and you'd been a W-2 employee for a little while, and you had a bunch of withhold, you pumped away a lot of money that you're going to get back. Any moves then?
Yeah. So that's the interesting thing about that is the immediate, reaction is, I want the money, right? Because it's going to have it. But the reality of it is that first year might be that typical just getting started lost year, and maybe you're going to take off from there and have a big profit in 2017 or 18, right? So you my suggestion in those situations, let's put the money, even though people hate to hear that, let's put the some or all of it, apply it to the subsequent period, so that if we make X amount of dollars as opposed to a loss, you've already covered your tax, so you're not going to be taking out money in terms of estimated payments. And normally what we do is project out what we think is going to happen based on the client's expectation. So I think I'm going to make X amount of dollars based on how well we did coming out of the first year. And if we feel we're going to owe 20 grand and we got a $30,000 overpayment, then we'll apply 20, get back 10. Unless they have a serious need. So there's, look, yeah, I'd love to do that, but
so you got to plot this stuff out.
You got to plot it out.
All right, I want to end this conversation because we got to get to another conversation. We don't have a lot of time on tax reform. So quickly, if tax reform happens, is it going to be effective for 2017 or 2018?
Well, if I'm not mistaken, about a week, I've been following this like almost every day, trying to wait to, you know, for our show and just for our clients, right? So there, I believe it was Paul Ryan had said they wanted to try to push it into 2017. Don't quote me on that, but there's been some official indication they would love to have it retroactively effective.
So it's conceivable the legislation could happen this year that would impact 2017's taxes.
Yes, it happened, I believe, in 10 or 11. They did something late in the year in December and made it retroactive. I think it was the reinstatement for the depreciation and all that kind of stuff.
So we don't know, but it could happen. We only
happen.
have about 30 seconds left. What are some of the high-level, most stark changes between what we know is taxes now and what could be it based on what you've seen so far?
Well, you know, they're making a big deal of the state and local tax deduction being eliminated. And unfortunately, my opinion is they're doing that in the wrong context because they're not talking about the repeal of alternative minimum tax, which in many middle to higher income families, is the alternative minimum income tax is eliminating the tax benefit for deducting state and local taxes anyway. But on October 31st, Halloween,
we got about 20 seconds left. Go ahead.
There was some indication they might retain the deduction for real estate taxes, but not income tax. So this is all going to be
a lot happening with itemized deductions. A lot of them going away. Some of them maybe staying.
Tax rates, a lot of things going to be.
And boy, if this happens for 2017, I don't want to see your office in a month or two.
Yeah, me neither. Frankly.
Oh boy, good luck with that, Greg. We're going to have you back to go over this in more detail, certainly come January. All right, up next, we're going to be talking about the likelihood that you're going to go back to work after you retire. Stay with us. There's more to come. Welcome back to the Money Pros. So most of you, if you think about retirement, say, boy, once I'm out the door, I am never coming back. But interestingly, more and more people are going back to work, in some cases full-time employment, after they officially retire. It's called reverse retirement, and statistics indicate 1/3 of retirees return to full-time jobs. And this is according to some data from investment bank Deutsche Bank, who did some research into this. And according to the Federal Reserve, half of retirees return to some type of part-time work during retirement. So there's a variety of reasons for this, but I wanted to put up a graph that also indicated another trend, and this is from Deutsche Bank, and it looks at different quintiles of the retirement population based on age. So over to the left is the lowest income retirees, through to, on the right, the highest income retirees, and then you have different gradations in the middle. And it looks at the percentage of retirees that actually go back to work. And you can see that the trend is pretty consistent across the board, that the percentage is somewhere between 30 and 35% of retirees that return to full-time employment. What's interesting here, though, is that the highest numbers of people that return are either in the lowest bracket of income before retirement or the highest bracket of income before retirement. So Deutsche Bank went on to speculate about some of the reasons why this might be, and I think it's interesting that we all reflect on this as we consider our own retirements. Most common with higher and lower income. For higher income, they suspect that it's due to opportunity costs. If you're making a lot of money before you retire and then you leave, you might start to regret all the money that you're no longer making. People might come to you with job opportunities. You're looking at significant amounts of money that you're not getting, and it may be more tempting to return to work. And then for the lowest income, it's probably no surprise that those people may realize that they simply don't have the resources that they thought they did when they go to retire. So it's an interesting thing to consider. Will you return to work in retirement? My experience is that many clients do return to some type of at least part-time work, maybe not because they have to, but simply because they want to. And one of the trends I've noticed is that spouses, even longtime spouses, recognize that even though they've been together, decades in many cases, that spending all of their time together might not be the best thing for the marriage. So many people continue to work if it's a work environment that they enjoy because they think it might preserve their marriage. So anyway, that's a little bit about returning to work after retirement. Up next, we're going to talk about a 130-year stock market trend that came to an end at the end of October. Stay with us. Welcome back to the Money Pros. In our last segment, I want to talk about a 130-year stock market trend that came to an end just yesterday. This is November 1st that we're taping this show, so it came to an end on October 31st. In 130 years of history of the Dow, and then to go back 130 years, you have to go back to predecessors of the Dow, and people that study finance have a variety of different ways of getting proxies for that information. For 130 years, the past 13 times that a year has ended in the number 7, so 2017 was one of those years, the period from August to November of that year experienced a significant stock market decline. In fact, the average drop of all 13 of those occasions was 13% in those 3 months. So that is a pretty dramatic decline in the stock market. The two worst, well, some of you may remember Black Monday in 1987, which was during that time period, where stocks declined over that total time period 36%. That was back in 1987. And then finally in 1937, the Great Depression, the period from August to November, saw a decline of over 40%. So those are the two biggest, but every single year, with a year ending in 7, going back 130 years, the market has had a dramatic decline in the period from August to November. And we've also talked about the idea that it's common for summers in any year to be very bad period in the market. We've talked about the phrase of sell in May and go away. Well, this year, the period from August to November was quite a bit better. Now, I had meant to look up the number, but I didn't. Suffice it to say it was positive, was not negative. So that is a trend that has come to the end. But I think the lesson here is that, look, the stock market doesn't have a calendar, it doesn't have a watch, it doesn't follow these trends. These trends are coincidental, and you certainly don't want to start betting money on them. So that's a little wisdom here at the Money Pros. Trend comes to the end. I'm sure there'll be another one starting up soon. Who knows? Thanks for joining us today. We hope you have the great rest of your weekend. We'll see you again next time right here on the Money Pros. Take care, folks.